Hello, everybody, and thank you so much for coming out here. It's always exciting when the KAR Annual Convention and Education Expo comes down to Wichita. We're real thrilled to see all the familiar faces, people we know from out of town, and glad to have you here in Wichita. And it is my great pleasure to present to you today the 2020 Kansas Housing Markets Forecast. As you saw, I hope when you came in the room that we have copies of the forecasts for all 5 of the major markets: Kansas City, Lawrence, Manhattan, Topeka, and Wichita. There are copies available outside. In addition, we have copies that should be available at your local Realtor board office. And so at least by the end of the week, there will be copies at each of the board officers here. So I encourage you, pick up the copies, take them with you, use them in listing presentations, use them in relocation packets, however it makes sense for you. We put together these publications as a service to you and to the community, and we could not do it without the generous, tremendous support of the sponsors of the local forecasts. On the back cover of each page, of each document, you'll see the sponsors of those local forecasts. But I have to say a special shout out to Security First Title. I think they're sponsor of almost all of the publications we have across the state. They have been friends. I think this is the 17th year that we've done a housing forecast in Wichita. And they've been a sponsor of that ever since the beginning. So really wonderful, tremendous, good friends. Thanks also to Merit Trust for their support of Wichita and for Manhattan and Lawrence. Capital Federal is new this year for Topeka, and we're real thrilled about that. And Fidelity Bank stepped up here in Wichita. They've got offices in Kansas City, and so we're real thrilled to have a lending sponsor for Kansas City. Credit Union of America sponsors some of our county outlooks, and that's the other piece that I wanted to mention, is that in addition to these large forecast publications, we prepare smaller county outlooks for 22 different counties across the state. All of those are available on our website. Many of them are available through Security First, the Security First offices in those local markets. So check those out, and I'd encourage you to take advantage of those publications as well. I also would be remiss if I didn't thank Karen Gailey and all the folks with Kansas Association of Realtors. It was, I believe, 11 years ago that you first approached us about trying to partner in both doing MLS statistical reports. So for most of you, the monthly statistical reports you receive come to you from us through a contract that we have with the Kansas Association of Realtors. And that's a service that's provided to you by the Kansas Association. But it's mutually beneficial, because if it were not for our access to your data, it would be much, much more difficult for us to be able to prepare these forecasts and to do the other things we do to support the industry. So thank you very much. And so with that, let's talk about the housing forecast. And most of you know my foundation for the housing forecast is always twofold. Number one, we look at labor markets. How are people doing with their jobs? Do they feel confident, and are they in a position where they think they might be interested in buying? And number two is financing. Will they be able to get a mortgage, at what cost, and how will that affect their willingness to buy or move in the market? The labor market has been really, really solid. Of course, we are in the longest expansion in post-World War II history right now. And in Kansas, unemployment rates are even lower than they are nationwide, lower than what we thought many years ago was a sustainable natural rate of unemployment. The flip side is the jobs numbers. So we measure these things 2 different ways. The unemployment rate we measure by surveying households, and we ask people, do you have a job? And for the most part, as we go across, most anybody who wants a job has a job. There's very, very low unemployment rate. Alternatively, we can measure it by surveying businesses and asking, how many people do you have on your payrolls? Now, this is a strange graph, but it presents some interesting and useful information. So let me explain it. what I've done is I've taken the total jobs numbers in each market across the state, and I've said, let's let the beginning of 2008 represent our benchmark starting place. Every other number on this graph is the total number of jobs relative to where we were back in the beginning of 2008, which was right when employment started to decline in the Great Recession. So you can see the maroon line here is Kansas City. It's at a level of 110. That means even after the job losses through the recession, Kansas City's total employment right now is 10% higher than it was back at the beginning of 2008. In the middle of this, you will see Lawrence, Topeka, and Manhattan, the gray, green, and teal lines. And while they bounced around a lot, somewhere between 100 and 105, meaning that you've regained all the jobs that you lost during the recession and are a little bit higher than you were before. The outlier down here is Wichita, where we are still not back at a total level of jobs that we had before. And the question is, how do we have this disconnect? Because unemployment rates are incredibly low, but Kansas hasn't seen as much job growth as a whole as the US, and some parts, particularly South Central Kansas, still are struggling to regain. And the answer to that in large part is loss of population. It is loss of the workforce. We have strong demand among businesses to continue to hire, but they can't find the people they need. And this is something that's true across the state with the possible exception of Kansas City. But even in Kansas City, if they could just get more people there to work, more jobs would be developed. It's not unique to Kansas. It's unique to lots of states in the central United States. The jobs and the population migration moving to the very large urban areas. And that's one of the things we're going to struggle with, to see more dynamic and robust growth. But that being said, the solid piece of it is that the solid piece of it is that we've continued to have steady employment growth, if not spectacular growth. The Center for Economic Development and Business Research at Wichita State just released their employment forecast last Thursday, and they are predicting that this year, total jobs across the state will be up just a little less than 1%, with a little bit slower growth next year, a little over 0.5%. That's been about on par with where we've been for the last several years. Stronger growth in the Kansas City area, a little bit weaker growth as you come down towards the Wichita area, but positive employment growth across the state. Again, if we had more people moving in with the skills that we needed, we could see even stronger employment growth. But the short answer for the housing market is the people who are here, who want to be our potential entrants in the housing market, have jobs. If anything, there's demand, there's competition for them. If they're good workers, there are other people who are interested in hiring them. They're seeing some reasonable wage growth. And so this is a solid factor for the housing market. The other side of it is the financing. And I think most of you in the room know that we've been in this, last year, this time, we said, this year will finally be the year that mortgage rates go up. And it seemed like we were on that path, right? Mortgage rates were really starting to trend up, and things like, hey, I'm really good at this predicting thing. And then something happened, and mortgage rates just began to fall again. And you'll notice that the Mortgage Bankers Association has given up. Every single year they said, we're going to go up to about 6%. We're going to go up to about 6%. We're going to go up to about 6%. This year, for the first time in about 8 years, they're saying, we don't know either. We're just going to sit here. They're predicting 4% interest rates through the end of 2021 now. What's causing these incredibly low interest rates in this strange environment? It's largely due to the very low interest rates that we have worldwide. You have other countries around the world with negative nominal interest rates. And investors who need to be in the financial system where they can actually trade currencies and trade be a part of that, of the transactions of money through the system. There are a limited number of securities, and U.S. Treasury securities are the best ones available, and that's driving a lot of these really low interest rates. The point being, it's this abnormal financial environment that is keeping mortgage rates low. I still don't believe where we are today is a sustainable interest rate in a long-term, stable, healthy financial environment. But how long could we stay this way? Ask Japan. They've been sitting there now for close to 30 years. So it's, all bets are off in the world we're in. But from a standpoint of housing markets, this is not a bad place to be. The other piece of the financing is underwriting and availability. And that also is really solid. How many of you have had a buyer here in the last year that's had a 0 down, no PMI loan? So only very few. Well, they're certainly available here in the Wichita market. And so underwriting standards are, I don't think that they're abnormally or excessively easy, but they are certainly not nearly as tight as they had been in the wake of the financial crisis. So we have very cheap financing with widely available financing. And so that all bodes very well for the housing market. So that's our fundamentals. They're solid. Financing is widely available and cheap. Labor markets are fairly healthy. But it's important to recognize that all of this could change in a heartbeat. It's just, when will we get T-boned in the middle of the intersection by a Mack truck driving down at 70 miles an hour? I don't know. If that happens, all bets are off. Okay, I'm not going to arrive at my destination on time. And so it is a strange world that we live in, and you have to accept that there's a certain amount of uncertainty out there as a result. Total side note. I love my graphic designers. They do a wonderful job with these booklets. And this year they had the idea of a historic perspective. And so they had a lot of fun looking at different historic images. This is one of my favorites in all of it. That is, in the 1940s, a Cessna aircraft worker. And she's doing her lipstick up against sheet metal. That's what she's using as her mirror. I just think that is one of the coolest pictures. The other one that is absolutely awesome, it's in all the booklets, it's on the Kansas forecast page. There's this little girl standing in front of a haystack from the 1930s. She's the most adorable little girl in the world. So I'd encourage you to check that one out. Isn't she darling? It's just, you can't believe that that's a picture from the 1930s. So we really enjoyed the pictures. I hope you enjoy them as well. So what do we have for the housing market? Well, this is the perspective of home sales across Kansas for the last 11, 12 years or so. As you can see here, the maroon bars are the actual sales as reported by MLS systems across the state. And then the yellow line is the moving average. So it's a way of smoothing through the variation, the seasonality throughout the year. And what you'll see is that as we came out of the Great Recession, we had an increase that, slow but steady increase all the way through last year. And over the past year or year and a half, home sales activities have essentially flatlined. And that's true in most markets across the state. But that leveling off of sales has nothing to do with demand. It has everything to do with a lack of inventory. Our forecast is that home sales are going to be down ever so slightly this year across the state, up next year. Here's the real way that I would take it away. About the same as we've been. More of the same is our forecast. And that's the theme that you'll see throughout everything here. Home sales activity would be stronger if only we could provide inventory in the price ranges in the neighborhoods where they're most demanded. So what's been happening here? This is a different way of looking at the numbers that I've tried to analyze here recently, where I've looked at the number of new listings relative to the number of closed listings. And what you can see is that over the past several years, this ratio has continually gone down Now we're down at a level of about 1.3 new listings per closing. Now, you may say, well, that's more listings than closings, but we all know, not every listing is going to sell, right? Some listings were never really intended to sell. They were just put out there. Some houses have problems. We need to have probably about 2 listings, now 1.5 listings per closing in order to really replenish our inventories, and we haven't been doing that. So as a result, inventories of homes for sale have been steadily declining. Now this is that measure of months supply. Once again, we take the number of active listings, homes available for sale in the market, and we divide it by the number of sales on average over the past year. We normally think of a balanced market as being somewhere between a 4 and 6 months supply. And by the way, if you look at the US figure, you'll notice we're right at the bottom edge of balanced. So when you hear people nationwide starting to do, oh, month supply is going up, or things are getting out of hand, and they start going, woe is me about the national housing market, 2 things. Number one, the averages nationwide they're still very healthy. And number 2, there's no such thing as a national housing market. Everybody owns a home in a city, in a neighborhood within that city, in a particular location within that neighborhood. And so we really have to think about things very micro. Even at the metro area level, there's a lot of variation that you have to make sure you're aware of. So one thing I wanted to do with this inventory is break it down and think about how are these inventories differ across different price ranges. And I picked some relatively arbitrary points, but I tried to capture some notion of homes listed below 100,000 as the lower end of the market. Homes between 100 and 250,000. In much of the state, that's the sweet spot. That's where the most desirable, in-demand homes are located. Homes between 250 and 500,000. Again, varies from market to market, but this would be the upper end of the middle market. And then homes listed above $500,000, again, what defines the upper end of the market is very market specific, but it gives us the same picture. And what we can see here is that in that sweet spot, between $100,000 and $250,000, we have month supply that is down around 2 months supply. Incredibly tight. In contrast, you go up above to the upper end of the market, homes priced above $500,000. It's a relatively flush market, 8 months supply. And again, you go into some sub-markets in some areas, and you could even be talking as much as a year's supply or more. What does this mean? It means that even though we have this strong pressure on prices in general, and we have this strong demand broadly, there are broad segments of the market that are not experiencing that. And I'm preaching to the choir here, but this is why I always say, as a buyer, as a seller, it's really important to work with somebody with local knowledge and local market expertise to be able to help navigate and say, how does this particular house fit into these broad trends? And that's where all of you come into play. So our forecast because of these tight inventories, our forecast for home price appreciation is very, very strong appreciation. Last year we saw average appreciation of 6.2% in the state. This year we're forecasting 5.2%, which again is really strong appreciation for the state of Kansas, and another 4.4% for next year. So more of the same, tight inventories, sales basically where they've been, home prices going up because of the short supply. The last thing that we forecast is new home construction, and that forecast is again more of the same. That's the theme of this year's forecast. Everything old is new again, right? It's more of the same. And so we did see a slight decrease last year, but that was we're bouncing back from that in 2020, essentially flat new home construction with the strongest construction happening up in the Kansas City area. That essentially is my forecast. I'm happy to answer questions. So there's the summary of what we have with all of our forecasts. And we do housing forecasts for all the markets. You've got that forecast summary in your publications. And you can access all of it on our website at realestate.wichita.edu. So I'm happy to take questions.
Is that on the Wichita market, does that include McConnell, or is that big enough to influence the numbers?
Well, our numbers that we are showing here, so on home sales, it is total home sales, both new and existing, that show up in the MLS. Anything that does not show up in an MLS is not reflected in our figures here. In terms of new home construction, it's single-family building permits. So if there's some sort of a multifamily construction or something else that's happened in McConnell Air Force Base or at Fort Riley, typically those won't be showing up because they're not a part of the permitting offices that are reporting. Okay? Yeah, right behind you there, yeah.
What percentage of home sales do you estimate in Kansas go through an MLS?
That's a really good question. And I'm going to caveat my answer here by saying that it's going to vary a little bit over time and it's going to vary a little bit by market. And my answer is a guess. But my guess is it's over 90%. Okay? The exceptions and the places where you really don't see it go through the MLS, number one is a lot of new home construction. New home builders may list something as a model home, but then when they do a custom home, it may or may not end up onto the MLS. And so that, we've always had a case where building permit numbers exceed the number of new home sales in the MLS. And it's not because builders are overbuilding, it's because not everything is showing up there. And then investor sales and those type of things when it's onesie twosies. But I think the vast majority of everything does show up in the MLS. And it's a good measure of what's happening even among those homes that aren't in the MLS. The MLS statistics are a good measure of the underlying trends of what's happening broadly. I saw this hand and then I'll come over there. Yeah.
Stan, can you comment on population growth of the Wichita market overall? I mean, you mentioned how some people might have leaved, but if you look around, all of the multi-housing that's going up in apartments is like crazy.
Right. Well, so when I said losing population, that was an overstatement of the underlying issue. We do see population growth in Wichita. We see population growth in Kansas. But what we are not seeing is any net in-migration. We see net out-migration. That is, our population growth is only because we're having more babies than we have people moving out of the state. Okay? And we are not seeing the kind of dynamic population growth that would really lead to stronger employment gains and then hence a lot more construction activity. So the employment growth in Wichita the population growth in Wichita has been well under 1%. It's been like 0.5%. And Jeremy Hill at the Center for Economic Development and Business Research does formal population forecasts for every single county in the state. And so if you go to their website, it's cedbr.org. CEDBR, which stands for Center for Economic Development and Business Research, cedbr.org, and you can find their population forecasts. They have both short-term and long-term population forecasts, and it's based in large part on demographic trends and the patterns of those, but also based on, IRS has some really good data on net migration across cities, and so they build that in as well. Steve.
Would you expect, do you feel like it's more likely that rates will be higher in 12 months or lower?
I think it's definitely more likely that they'll be higher than lower, but that's just because there's a lot more room for things to go up than it is for them to go down. Now, if you were asking me a 50 basis point move, maybe I'd say a 50-50 either way. But certainly more than a 50 basis point move, there's a lot more room for it upward than downward.
And what about 2 years?
Again, the further out you go, the more likely I would say up to down. But I've been saying that for a long time and I've been wrong. So
You haven't been alone in that. But the global
certainly what's driving long-term rates down right now, and also putting pressure on short-term rates. I mean, what's driving these rates right now is the fact that there's no yield to be earned anywhere across the world in the financial system. And so that means investors are sending their money here, and when they buy U.S. Treasuries, that drives down the interest rates. Other questions? Yes?
Do you have any studies like this on the western part of the state from Hutch, Dodge?
So we do not formally forecast the markets in the smaller markets. And the reason, quite frankly, is that when you have a smaller number of sales, the variability becomes such that it really becomes difficult to forecast with any precision. Okay? But what we do is we prepare county housing outlooks. So we provide information about the unemployment rate, information about what's happened with home sales activity, median sale price, listings and inventories and so forth. But it's only historical, not with a projection going forward. And again, we have that for Dodge, we have that for Hayes, Liberal, Garden City, Great Bend, Pratt, all the micropolitan areas across the state, we've included those. Yeah. And again, shout out to Security First Title because they make that happen. If it weren't for them, we couldn't do it. Well, if I don't have any other questions, then thank you very much.